What if I told you the biggest money manager on earth is quietly changing sides? Not with headlines, not with press releases, but with trillions of dollars moving under the surface. What if this isn't a trade, but a warning? And what if, by the time most people notice, the game has already changed? BlackRock doesn't panic. It doesn't chase noise. It moves early, it moves quietly, and it moves with size that reshapes markets without asking permission. When an institution overseeing roughly $14 trillion begins repositioning capital away from traditional U.S. banks, that's not a tactical adjustment. That's a signal. And history says you ignore those signals at your own risk. For decades, U.S. banks were the core plumbing of global finance. They sat at the center of credit creation, liquidity, leverage, and trust. If you wanted exposure to economic growth, you owned banks. If you wanted safety, you owned the biggest ones. But something has shifted, not suddenly, gradually, and now it's accelerating. Look at the environment banks are operating in. Higher interest rates were supposed to be a gift, wider margins, more profit per loan. That was the theory. The reality is more uncomfortable. Rate volatility has exposed balance sheet mismatches, long-duration assets funded by short-term liabilities, unrealized losses sitting quietly, waiting for stress to force them into the open. Regulators know it, institutions know it, and BlackRock absolutely knows it. At the same time, the rules of the game are changing. Capital requirements are tightening. Stress tests are getting harsher. Political pressure is rising. Banks are being asked to do more while taking less risk, lend more while holding more capital, and somehow remain profitable in a system that no longer rewards leverage the way it used to. That's not a growth story. That's a slow squeeze. Now zoom out. BlackRock doesn't just look at earnings. It looks at structure. Where is capital treated best? Where is flexibility highest? Where can trillions move without friction? Increasingly, the answer is not inside traditional banking balance sheets. It's outside them. Private credit, infrastructure, energy transition assets, data centers, ports, power grids, assets that throw off predictable cash flows without relying on deposit bases or overnight funding markets. Assets that benefit from inflation instead of being crushed by it. Assets that don't wake up one morning to a bank run triggered by a spreadsheet leak on social media. This is where the repositioning starts to make sense. It's not that BlackRock believes U.S. banks disappear tomorrow. It's that their role as the primary engine of financial returns is fading. The center of gravity is moving. Capital is flowing toward real assets, private markets, and structures that operate parallel to the traditional banking system rather than inside it. And here's the part most people miss. When capital leaves banks, even slowly, banks don't just lose money. They lose influence. They lose pricing power. They lose their ability to intermediate the economy the way they once did. That changes everything. Credit costs, market volatility, who gets funded and who doesn't. BlackRock isn't reacting to a crisis. It's positioning ahead of one. Not a dramatic collapse, but a long grinding reordering of how money moves through the system. And once that shift reaches a certain point, it becomes self-reinforcing. Because capital follows capital, especially when trillions start moving in the same direction at the same time. Now think about what that means for the average investor watching bank stocks trade sideways while risk keeps rising. When the largest asset manager in the world reallocates capital, it doesn't do it out of fear. It does it because the math no longer works the way it used to. Banks used to thrive on maturity transformation. Borrow short, lend long, pocket the spread. But in a world where rates can jump faster than models can adjust, that model becomes fragile. Liquidity stops being a given. It becomes a premium. BlackRock sees that premium shifting. Deposits are no longer sticky. Money market funds now compete directly with banks for cash, and they're winning. Why leave money in a bank, earning almost nothing, when you can park it in a fund backed by treasuries and earn more with fewer headaches? That drain matters, because deposits are the oxygen of the banking system. Without them, banks rely more on wholesale funding, which is volatile, expensive, and unforgiving when stress hits. At the same time, the U.S. government's borrowing needs are exploding. Trillions in new debt, constant issuance, that crowds out private lending and pushes yields higher for longer. Banks are forced to hold government paper for regulatory reasons, even when it hurts their balance sheets. That's not optional, it's structural. And BlackRock understands structure better than almost anyone. So instead of fighting the system, it's building around it. Private credit is the perfect example. Corporations still need financing. Projects still need capital. But that financing no longer has to come from a bank. BlackRock can step in directly, negotiate terms, secure collateral, and lock in returns without dealing with deposit flight or daily liquidity demands. That's a cleaner trade in this environment. This is also why infrastructure has become so attractive. Governments are spending again. Energy grids need upgrades. AI demands power, water, land, and connectivity. These are long-duration assets with government-backed or regulated cash flows. Banks might finance them, but BlackRock wants to own them. Ownership captures inflation upside. Lending just captures interest. There's also a geopolitical layer here that rarely gets discussed. U.S. banks are deeply embedded in the dollar system. Sanctions, regulations, compliance costs, political pressure, all of that adds friction. Capital doesn't like friction. By shifting toward global real assets and private markets, BlackRock reduces exposure to any single political jurisdiction. That's not anti-American. That's risk management at scale. And let's be clear, this isn't a bet against the U.S. economy. It's a bet against an outdated financial architecture, one built for a low-rate, stable world that no longer exists. Volatility is the new baseline. Policy uncertainty is permanent. Debt levels are unprecedented. In that world, flexibility beats tradition. So when people ask why BlackRock is repositioning trillions, the answer isn't dramatic. It's disciplined. Banks are becoming utilities, lower returns, higher oversight, less room to maneuver. Meanwhile, private markets are becoming the new engines of growth and control. That's where influence is migrating. That's where returns can still be engineered rather than hoped for. And once you see that shift clearly, you start to realize this isn't just about BlackRock. It's about the future shape of the financial system itself, because when the biggest player changes direction, everyone else eventually follows, whether they want to or not. And that brings us to the most important consequence of this shift, which most people still aren't prepared to fully grasp, because it doesn't show up on earnings calls or balance sheets. It shows up in power, pricing, and access to capital itself, which is why the next phase of this story is far more disruptive than most investors expect, because it fundamentally changes who decides where money goes, who gets funded, and who gets left behind in a system that is quietly being rewritten from the inside out by capital flows that don't ask for permission, only opportunity. And once that door opens, it never really closes again until something breaks or something replaces it entirely. And that moment is closer than it appears right now. This is where the conversation gets uncomfortable, because when banks lose their central role, the consequences don't stay inside Wall Street. They spill into the real economy. Credit doesn't disappear, but it becomes selective, more expensive, more conditional. When capital is controlled by private markets instead of regulated banks, access changes, terms tighten. Relationships matter more than credit scores. Size matters more than ideas. BlackRock understands this leverage. If you control capital, you don't just earn returns. You shape outcomes. You decide which industries scale and which stagnate, which regions grow and which are starved of funding. This is why the shift away from U.S. banks isn't just financial. It's structural power moving from one part of the system to another. Think about small and mid-sized businesses. They rely on banks. They don't issue bonds. They don't tap private credit funds easily. As banks pull back, these businesses feel it first. Lending standards tighten. Lines of credit shrink. Expansion plans pause. Meanwhile, large corporations with access to private capital keep moving. That gap widens. BlackRock isn't causing this divide, but it's positioning itself to operate on the winning side of it. And then there's liquidity. Banks provide daily liquidity. You can withdraw your money. You can move fast. Private markets don't work that way. Capital is locked up. Redemptions are limited. That sounds like a downside until volatility spikes. Then illiquidity becomes protection. Forced selling disappears. Panic is muted. Returns smooth out over time. For an institution managing trillions, that stability is priceless. This also explains why BlackRock keeps talking about long-term themes instead of short-term trades. Energy transition, artificial intelligence infrastructure, supply chain reshoring. These trends require massive capital and long timelines. Banks aren't designed for that anymore. Private capital is. And once those assets are built, they don't just generate returns. They become essential. You can't shut down a power grid or a data center because markets are nervous. Here's the quiet truth. U.S. banks are becoming system managers, not growth engines. Necessary, regulated, stable, but constrained. BlackRock doesn't need them to disappear. It just needs them to step aside enough for capital to flow where returns justify the risk. And that's exactly what's happening. So when you hear about a $14 trillion repositioning, don't imagine a sudden sell-off. Imagine a slow, deliberate redirection. New funds launched, new mandates written, new assets accumulated. Over time, the weight shifts, and by the time headlines catch up, the balance of power has already moved. This is how financial revolutions actually happen. Not with crashes and chaos at first, but with quiet decisions made by institutions that think in decades, not quarters. BlackRock isn't predicting the future, it's building around it, and the future it sees is one where traditional banking plays a smaller role, while private capital, real assets, and direct ownership define the next era of finance. The real question isn't what BlackRock is doing. The real question is what happens to everyone else when the biggest allocator of capital in the world decides the old system no longer offers the best risk-reward trade-off. Because when capital moves, opportunity moves with it. And those who understand that shift early don't just protect themselves. They position to benefit from a financial landscape that looks very different from the one most people are still relying on. In the end, this story isn't about fear or collapse. It's about adaptation, about recognizing that the rules have changed and adjusting before you're forced to. BlackRock is doing what it has always done best, reading the structure, anticipating the pressure points, and moving capital ahead of the curve. The $14 trillion shift away from U.S. banks isn't a vote of no confidence. It's a roadmap. And for anyone paying attention, it tells you exactly where the next chapter of global finance is being written.